What I wanted today is to talk about a number of themes in the global economic outlook, drawing on the research that we do as a economics team across the globe. And there are a number of themes that I'm going to touch upon. Some of them have more near-term cyclical relevance, but there's also some longer-term structural or secular themes that I want to address as well. And I think it's those secular themes that should give us all a bit more food for thought in terms of implications for portfolio construction and for investment strategy. Well, let's start with the sort of right here and now. Look, there's no doubt that there's a heightened degree of anxiety about the global outlook, and it's been that way for an extended period of time. At any given day during the course of this year, you could have picked up the paper and there would have been at least half a dozen headline-grabbing stories upon which to focus your concerns, be they the ramifications of the Great East Japan earthquake and tsunami, the implications that might have for global supply chains or the nuclear power industry, whether that's trying to interpret the latest developments in the European sovereign crisis, from trying to decipher the latest acronym that's been added to the lexicon, be that the EFSF or the ESM or the SMP or the ELA or the other range of things that the Europeans have been throwing us, to trying to decipher the latest utterings from the so-called Troika, the officials of the EU, the ECB and the IMF, or deciphering the latest utterings from German politicians. There's been a whole host of stuff on that front to worry about. And then, of course, we've had to worry about the ifs, the whys, the whens, the so whats of the Federal Reserve's quantitative easing program, whether we get QE3. And there's a whole range of things that we could have been worried about. Now, human nature being what it is, we're inclined to have a look at the most recent developments through the lens of the crisis that we've just been through. So to some degree, there's an element of anchoring going on there. And so what you find with a lot of these stories that we see from day to day is they're wrapped up in analysis about whether this means that we're travelling down the same path that we went down in 2008. I think it's important to remember, though, that there's no predetermined path here. There's no guarantee that we're going down that route at all. And I'm going to illustrate that with what some might consider to be quite a trite example, but it only seems trite, I think, because we know what the outcome is in hindsight. I'm going to illustrate here how some economic fundamentals looked in 1998 versus the 2008 episode versus where we are now. So the chart that you can see on your right there shows the behaviour of the US stock market, the S&P 500, in the 3 months or so in the run-up to the peak in equity markets in 1998, 2008 and the current episode. The 1998 one's actually the blue line you can see there, 2008 is in green, and the red one is where we are now. And you'll see there's quite a strong similarity between all three episodes there. In the first phase of these crises, stock markets ended up falling by around about 15%. And the players at the time, or the villains of the piece, if you like, in this, have some broad similarity between those three episodes. In 1998, there was still persistent worries or anxiety about the global economy as we were coming out of the Asian financial crisis. In 2008, of course, it was subprime, and now, of course, we've got the worries from 2008. There were also sovereign debt fears. Remember back in 1998, we had Russia defaulting on its debt in August and September of 1998. There was also sovereign fears around Europe then, because we were still in the process of the run-up to the start of European Monetary Union. Bond markets adjusted a heck of a lot through that period as well. In 1998, the US Treasury yield, the 10-year Treasury yield, fell by about 150 basis points during that stock market correction, pushed mainly by a collapse in inflation break-evens. So people were worried considerably about deflation through that episode as well. So a lot of similarities between those three episodes, I think, but a great deal of difference in terms of what happened to the episodes we know about in 2008 and 1998. In 2008, which we're all remembering quite sharply, of course, we had a further leg down in equity markets very sharply as we had Lehman's collapse. In 1998, we actually had stock markets go the other way. The fears about the financial system at that time are, of course, centred around LTCM. Policymakers successfully ring-fenced LTCM from damaging further the financial system, and risk assets recovered. The point of this chart is not to say that we're going down the same path as 1998, that we expect some massive recovery in risk assets. The point here is merely to illustrate, I think, that there is no predetermined path that we are going down. We're not necessarily tracking 2008. There's a whole myriad of possibilities, possible paths, possible outcomes that we could follow. Having said that, some markets already seem to be on the path of pricing in something like that 2008 episode. Most clearly that's seen, I think, in the bond market. So what I've drawn in this chart here is one very long-term valuation measure, if you like, of government bond yields. So it's a measure of global government yields, so across a range of industrial countries, and I've taken out the inflation influence on those yields. So it's a measure of real yields. And I've shown it here through right back to the mid-1960s and through a variety of different macroeconomic regimes. So from around about the mid-1960s through to the end of the 1970s, that was an era in which we had rising inflation, rising economic volatility. In the second regime in the middle there, that was an era of largely falling inflation and declining economic volatility, a theme I'll come back to again shortly. Of course, in regime 3, the most recent episode we've been through, it's largely characterised by stable inflation. Now, it's very rare in history to find a situation in which bond yields are any lower than where they are today. On this metric, real bond yields globally are about 0.6%, which is extraordinarily low. And that's telling you something, I think, about the sort of economic scenario that's being priced into this particular asset market. In order to gauge that scenario, one of the things that we do is to run an econometric model which maps our forecasts for growth, for inflation and for policy rates onto bond yields. That says, given our forecast, where should bond yields be? And if we feed a scenario that I think is still relatively gloomy through our framework, one of growth going sideways and unemployment drifting higher, one of inflation starting to fall again, and one of policy rates being on hold for an extended period, you end up with a fair value for US 10-year Treasury yields of something like 3.25%. So that's around about 1.25% above where the US Treasury yield is trading now. And you can look at that in two different ways. One way to look at that is to say, well, hang on, what sort of economic scenario do you have to assume in order to make a 2% Treasury yield fair value? Well, it turns out you need to have something like a rise in the US unemployment rate from its current 9% to 12%, a collapse in inflation back down to towards 0%, and the Fed doing nothing for an extended period in order to justify that. Now, I think that's a pretty gloomy scenario. That is a genuine double dip. The other way of looking at this is to say, well, this is a measure of how much extra premium investors are prepared to pay for safety. They're effectively giving up 125 basis points in return, and that's the price they're willing to pay for safety. Either way, I think that's a measure of how extreme pricing has got to in sovereign debt markets across the globe. Now, that's not to say that there aren't reasons for that angst and that anxiety. As I touched on right at the start, there's a whole shopping list that we could be looking at. And one of the things we do as an economics group, one of the things we do as a funds management group more broadly, is to spend a lot of time, a lot of meeting time, a lot of email time, a lot of chopping down trees time, discussing those sources of angst. So most of the last 18 months has been spent going round and round in circles talking about the ins and outs of the European debt crisis, whether Greece will actually default, the implications of that, whether Greece, Portugal, Ireland and others can leave the euro, whether Germany can leave the euro. There's a whole myriad of questions that we could address. And we do that, I think, partly because as economists, that's kind of fun stuff for economists to do. But also I think it's because, again, it's a degree of anchoring, that we see this stuff hitting the headlines every day, and that's what we think we should be focusing on. But sometimes I think it's worthwhile stepping back and focusing on things that are not hitting the headlines every day. And I think there are three questions that we've been trying to discuss as an economics group, which I think have ramifications more broadly for investors. The first of those is, are we spending too much time talking about old economy issues, that is, talking about sovereign debt crises and deleveraging pressure in the United States? Why aren't we talking more about emerging markets as a driver of global growth? After all, we all know the numbers there. So this chart tries to illustrate how much the contribution of emerging markets to global growth or global activity has changed over the past 20 years or so. The chart on the left shows that in 1992, the early 1990s, EM was around about a third of global activity. It's pretty much now, 2010, 2011, we're up to about half. So there's been a dramatic shift in the share of emerging market economies as drivers of growth, and a lot of that has come, as you can see on the right-hand side, via the expansion of Asia. It hasn't really been LATAM or Eastern Europe that's driven that expansion. And in some ways, these numbers, I think, understate the degree to which that balance of power has changed, because that's also a period in which EM has become a much more greatly integrated into the global economy. So we know the numbers, and we know the 2009 story, which is effectively one of emerging market-led growth for the global economy, and yet we're still inclined to take a developed market view of EM. That is, we're more inclined to have still look at the EM growth prospects as some sort of leveraged derivative of developed market growth. And I think that's wrong. I think there's enough oomph in the emerging market economies, if you like, to be a driver of growth in their own right. And that's particularly true of some of the economies in our region, China, India, Indonesia in particular. Not only do these economies have implications for how we think about growth dynamics, they also have implications for how we think about my second question, which is, why don't we think much more about inflation dynamics? We've solely focused almost on the outlook for growth. We seldom discuss enough, I think, about the inflation outlook. And it's clear that emerging markets are having a significant impact on the global inflation picture. What this chart tries to do here is to have a look at the performance of developed market inflation across the four main categories of consumer price inflation, of food, energy, goods and services. And it breaks up the last 20 years into 4 5-year buckets. If a bar here is going below the line, it's telling you it's putting downward pressure on overall inflation. So if you have a look at the early 1990s, the blue bars there, generally food and energy and to some extent goods inflation were putting downward pressure on overall developed market inflation. As we went through the next couple of 5-year periods, the key thing to focus on there is core goods. So core goods deflation intensified as we went through there. So that's the role of China and other emerging market economies becoming a much greater part of the global economy. At the same time, food and energy inflation started to ramp up. In the last 5 years, I think we've reached a tipping point. That is the influence of the commodity consuming economies across the emerging market countries has been pushing food and energy prices higher. And at the same time, we're starting to see the downward pressure on goods prices or goods price deflation start to wane. So that's making, I think, the task of inflation management in many developed countries a much harder ask than it has been over the previous 15 years. Merv King, the Governor of the Bank of England, used to call that sort of period from the early 90s through to the mid-2000s the NICE era. I think it stands for non-inflationary, consistency, expansionary episode. I think things are turning not so nice right now. Let's face it, when you take a broader view of inflation, inflation really hasn't gone to script through this episode. What I've done here is to have a look at global inflation, consumer price inflation, so it's a pool of about 15 different developed countries. Core inflation is in red and headline inflation is in blue. And as we were going into the Great Recession, what many analysts, policymakers, etc. thought was that we're going to have a collapse in consumer price inflation because the output gap or the degree of unemployment had increased by so much. But that's not really what happened. Yes, inflation dropped to some extent, so core inflation dropped by about a percentage point through the Great Recession, but it's now started to pick up again, despite the fact that most industrial countries are facing very high unemployment rates. Now, that's important because this means that the dominant model which central banks use for thinking about inflation, I think, is under threat. So you have central banks who are facing an environment where the inflation picture is getting more difficult because of EM. where inflation targeting really didn't deliver what they hoped, which was economic and financial stability, and where the relationship between unemployment and inflation seems to be breaking down. So what you're seeing is a wholesale reassessment on the behalf of some central banks about how to engage in monetary policy. That's quite marked in the United Kingdom, I think, where you've had this debate over the last 12 months or so, quite polarised debate between those who are looking at current measures of inflation at 4% plus, saying that they should be hiking rates, to those who are looking at measures of money and credit growth, so going back to old-time central banking, if you like, saying that there's no need to hike rates at all. And that dichotomy we're seeing there, that split, I think, is repeated across a number of central banks. At the same time that we're getting this debate, many central banks are using different policy measures, no longer just the overnight cash rate, in terms of implementing policy. What that's doing is contributing, I think, to a greater degree of uncertainty about how policy is going to have an impact on economies. And ultimately, that sets the stage, was one of the ingredients behind thinking about increased macroeconomic volatility. And that's my third question. Do we spend too much time thinking about central case for growth and not enough time thinking about the ups and downs of growth? Because what's happening now, I think, is that we've come to the end of this regime that people called the Great Moderation. Here's one way of illustrating the Great Moderation. This is GDP growth for the US and the UK, but I could have drawn almost any industrial country. From the 50s through to the mid-1980s, you can see their growth very volatile, lots of up and downs, short, sharp business cycles. From the middle of the 1980s through to the start of the global financial crisis, we had this marked compression in macroeconomic volatility. That's now starting to unwind. It's unwinding in part because of what I said earlier about monetary policy regime. It's unwinding too because getting out of the sovereign debt crisis for many economies is going to be a very stop-start affair. It's going to be an affair which ends up contributing to volatility significantly. And I think we're having a reassessment about how much of that period from 85 through to the start of the global financial crisis, how much of that low volatility was actually dumb luck rather than good management. So with that rise in macroeconomic volatility, there's two aspects to that effectively. One is short, sharp business cycles. The other, I think, is much greater dispersion of outcomes between countries. And that's a change in theme for the last 20 years, where the last 20 years has largely all been about convergence of economic growth, economic outcomes between countries. I think we're going to an era now where it's much more about divergence. Now, those themes, I think, have some implications or some important implications for how we think about portfolios and portfolio construction. Now, let me just list off three. The first one is when you're thinking about the role of bonds in the portfolio, you've got to ask yourself the question whether your traditional bond allocation, so let's say an indexed allocation to global sovereign bonds, is going to deliver you what you want. That is, what you want from that allocation is stability, some income or some return, and an anchor to windward. So a performing asset when risk assets are underperforming. But when yields on the global sovereign index are already down at 1.8%, I think it's virtually impossible for that allocation to play the role in which it was desired. So that sets, or certainly set off to us down the route of looking for other ways to construct bond portfolios which will deliver that sort of outcome. And for us, that means going down the route towards absolute return strategies or benchmark unaware strategies. The second question is about increasing divergence. So what does that mean? That means that it may matter a heck of a lot more which countries you have exposure to. In my part of the world, in bond markets, over the last 20 years, it hasn't really mattered which bond market you've had exposure to. They've all performed pretty much the same. That's not going to be the case going forward. Much greater divergence in outcomes, which means a much greater need for searching for active opportunities. And again, that's one of the reasons why we've gone down the route of starting to look at Asian bonds or Asian bond beta as a way of getting different exposure. The third implication, I think, is perhaps one for asset allocation, in that if we're going to an environment where there is much more macroeconomic volatility, then that implies, I think, more asset market volatility and more opportunities for taking a dynamic approach in asset allocation, or at the very least, being quite nimble in terms of the decision-making process. I'm going to leave it there. I'm out of my 20 minutes time, and I'll pass over to Matt to talk about Australia.
Now, as Guy said, I'm going to focus a bit more on Australia, but it's actually a bit hard to articulate the outlook for Australia without some reference to the global picture. With all the volatility that we've been seeing in markets, investors do have to ponder their asset allocation in an environment where equity market valuations are a lot more attractive, but of course the economic risks to the economic outlook are materially higher, and of course bond valuations are incredibly stretched. Now, the primary macro risk at the moment is that we will remain in an anemic growth climate due to the unwinding of a 25-year leverage boom from the US economy. Now, during this period, income rose 4 times, but debt rose 8 times. So therefore, what we saw in this red line here is a doubling virtually of the debt to disposable income ratio. Now, the GFC brought all of that to an end, and America has now entered its fifth distinct period of deleveraging over the past 50 years. And during these periods, there's 2 key questions that we need to ask. What's the average growth rate during these periods, and what's the average duration of the deleveraging cycle? And if we just have a look at the economic growth rate in those grey bars, what we can see that normally when households are leveraging, economic growth is around 4%. But during deleveraging cycles, growth slows dramatically down to just 1.5%, driven by slowdowns in consumption growth, investment growth, and government spending. Now, of course, government spending is the most significant contributor to growth during these periods. But of course, we all know that we're into a period not only where households have to deleverage, but also governments. So the outlook for the US, European and Japanese consumer is very weak. And this really is concerning some investors, of course, because the US consumer is the world's largest. And of course, lower demand should decrease production or Chinese production of consumer goods and have an impact on its economy through exports. So the first question we're going to ask here is that in the last 5 years, how much of China's growth came from net exports? Is it 35%, 25, 15 or just 5? Okay, most people said it was 25, 15. It's only 5% actually, as you can see in this next chart. What you can see, this is China's growth in 5-year blocks over the past 30 years. And what we can see is growth overall hasn't really changed that much from each 5-year period. It's around 10% plus or minus a couple of percentage points during the period. But what we can see is that those red boxes, the contribution from net exports, have been progressively getting smaller over the past 25 years. So the Chinese economy, even though a lot of people describe it as a massive exporting economy, and it is, what I call it, it's actually a big turn-belt economy. It imports a lot of raw materials, repackages them, and sends them back. So if all of a sudden there's a slowdown in demand for Chinese exports from the US, there's also going to be a similar slowdown of America imports into China. And the overall impact on the economy from the trade perspective is going to be quite marginal. But nonetheless, China can experience a softer growth because of its impact on confidence with all this volatility. But we also have to keep in mind the Chinese authorities have truckloads of ammunition to fight at any growth slowdown, whereas the US and the European authorities really only have a handgun with no bullets in it. So literally all they can do at any problem is throw the gun at it. But China, of course, has a lot of artillery left, as I said. So China's outlook is still very strong, underpinned by their broad-based urbanisation and industrialisation. But China's also starting to enter the next stage of its industrialisation, where its steel intensity will start to decrease and its energy intensity will start to increase. So China's biggest problem clearly isn't growth. China's biggest problem at the moment is inflation. And what we can see here with its impact on food prices, for example, food prices have increased in 9 of the past 11 years and by 170% overall. And of course, it's not only what people are consuming, but also the energy they're consuming. And you can see here that overall, world energy demand is continuing to rise. Sometimes the oil price is above where it should be, like it was in July 2008. Other times it's below where it should be just after the GFC. Right now, it's not too far away from where it should be. overall food prices are rising, energy prices are rising, and because of a result, we have slow growth in the US and Europe because of domestic factors, but we have rising inflation because of global factors. And the impact on each economy depends whether they are a net energy producer like Australia and Canada are, or they're a net energy consumer like America and Europe are. Now, when we have a look at the Australian economy, its outlook is pretty well known. The consensus story is that rising coal and iron ore prices will drive up our terms of trade, lead to a surge in mining investment, and of course lower unemployment. Now, the big question here is this investment boom, when's it coming, how big's it going to be? Now, the CapEx figure tells us this mining boom is likely to be, or expected to be, the biggest mining investment boom since the gold rush in Victoria in the 1850s. But the key question we have to ask is that can a sector prone to capacity constraints and skill shortages actually deliver this boom on time and on budget? And what we can see at the moment is that over the past 11 years, mining investment has increased at a rate of 15% per annum. In fact, now we invest more in mining than we do in new housing stock. And of course, to prove that those CapEx figures right, the growth rate in mining actually has to continue to grow at an accelerating rate. And to show how big it's got to grow by, I actually had to put those lines on a new axis. And this is what mining's got to grow by in the next 12 months for those CapEx figures to be proved correct. Now, over this stage, you've got to double your investment in mining, so therefore you're going to have to double your employment growth and double the number of workers. But since the GFC trough, the employment growth in the mining services and construction sector has only increased at around 7% per annum. So at the moment there's a lack of workers, and that means inevitable delays, and there's also a lack of global capital, which means inevitable cost blowouts. And when we have a look at the largest 24 mining projects in Australia since 2006, in terms of schedule slippages, in other words how late they are, and the costs overrun, what we can see, only one project has come in on budget and 5 projects have come in on time. And no projects have come in on time and on budget. And this problem is progressively getting worse. The average schedule slippage is around 11 months. The average cost blowout, of course, is around 50%. So this really tells us that given the dynamics we have in this industry, we just cannot simply deliver this mining boom on time like the CapEx figures suggest. What it means, though, is that the mining boom is going to be less egregious, it'll be smaller, but it will be more prolonged. And of course, that will certainly help the growth dynamics of the Australian economy. But of course, the mining boom is only 10% of the Australian economy. And the consensus story I told you about is not, of course, the whole story. What we can see is that conditions in the other 90% of the Australian economy are very subdued pretty much across the board. Now, some of this reflects the impact of higher interest rates, such as in the finance and the construction sector. Some of it reflects the impact of the higher currency, such as in manufacturing and education. And some of it reflects both, such as the trends we're seeing in the retail sector. Now, overall, what we're seeing now is the consumers, like in America, are starting to save more and more, and that big leverage boom is over. Now, some of this is driven by similar factors as we see in the US. Asset prices are declining, household balance sheets are being delevered. But also what we're seeing in Australia is the fact that we're seeing consumer prices are rising quite significantly. So if we have a look at a breakdown of the Australian inflation rate, what we can see is that cost-push prices in sectors such as health, education, property, insurance and utilities are rising, and they're rising very sharply, and they're actually absorbing a lot of disposable income. And because we can't diversify away from those costs, because we need to eat food, we need to have electricity, we need insurance, you've got to live somewhere. That means that households are actually having to make spending cuts elsewhere in their household budgets. And what we're starting to see is that the easiest place for them to cut back, of course, is their discretionary spending. So as a result, we can see that the retail sector is really struggling very badly during this transition in the Australian economy. Retail sales in Australia are now growing at around 2%, which was much less than the average growth rate we've seen in the last 40 years of 8%. But the 2% itself is entirely driven by price increases and population increases. And if we have a look at the real spending per person in the Australian economy, what we can see, it's actually at an all-time low of -4%, and well below its 50-year average of around 8% growth. So overall, households aren't spending, and of course households aren't borrowing, and neither are businesses. And we can see now that credit growth in the Australian economy is at around its lowest level other than the 91-92 recession that we had to have. So growth is now very much in Australia one-dimensional. And because of that, that makes us a lot more exposed to shocks in the mining sector and also a lot more exposed to any kind of policy error. So when we have a look at the RBA's growth forecasts in an environment where the US and Europe are going to remain extremely weak, the ex-mining sector is also very weak, and the mining boom will be less egregious than what the RBA thinks, I think their growth forecasts for 2012 are just simply too high. And whether the outlook for underlying inflation is too high, I think will be driven by the developments in the US and Europe over the past next 6 months. Regardless of what happens there, though, I think we are in for a period of a prolonged period, I should say, of rates on hold in Australia. Growth will be a bit slower, and I think the RBA will probably want to see how this actually transitions, all this volatility, to spending patterns in the Australian economy. So pretty much what we have now is a world where growth is a lot more one-dimensional and the Australian economy is very much two-paced. And in terms of the implications of that for investments, what we have to realise, as Guy said, is that Asian growth is now pretty much driving the entire global economy. And their outlook is still very good. And for the first time in 150 years, in 2012, the combined economic output of India and China will be greater than that of the United States. And so growth there can remain very anemic, as it can also for Europe and Japan, but the global growth picture can still remain quite intact. So what we can also have then is that we're coming into a world where income is going to be a lot more important to investors' total return than it has been in the past 25 years. And so one key question we have to be asking is that although income in share market returns was a very minor contributor to investment returns since 1983, we have to be asking the question of how much did it return to investors in the 100 years prior to that. So post-83 it was 25%. What was it in the 101 years prior to that? 57%, correct. Excellent. Yes, that's exactly what it was, and it was 59% globally. So we've been living in a world which is very much in the last 25 years has been out of the historic norm. And so we're going back to what had always been the case prior to that great moderation, where interest rates fell and drove up capital value for the same growth in dividends and for earnings. And so therefore we have to be asking, in this very much two-paced economy, in a very much two-paced global world, what sort of stocks can actually achieve income growth, because that is going to be so important for investors' total return. And the good thing, of course, is the sort of stock that will do that has not changed from between 83 and now. It is exactly the same sort of stock. Stocks with very strong balance sheets, stocks which generate strong surplus cash flow, have sustained market power irrespective of what industry they're in, and of course boards which are focused on their payout strategy. That's been the same since the dawn of time. But of course, not all companies are going to be experiencing income growth in this very tight economic conditions. And in fact, exposure to those sectors which aren't going to be doing particularly well could actually drag down investment returns in what is going to be a low returning world anyway. And of course, income can not only be found, of course, in the Australian share market and the global share market, income's also important, of course, in bond markets. And so what we can see here is the contribution from the major markets between income and capital growth. And so I think income is also going to be a lot more important in fixed income markets than it has been over the past 25 years. So our last question for today, and that is Australian credit. It's likely to experience less defaults than its global peer because the Australian economy is structurally stronger. Australia's traded debt market is of a higher quality universe. Australian leverage is historically low, or all of the above. Okay, all of the above is kind of a dead giveaway, isn't it? Because you wouldn't have that in there, of course, unless that is indeed the case. Yes, and what we can see here is that the Australian economy is structurally stronger than the US, of course, because we're a net producer of energy. And as a result, when we have a look at the credit spreads available in the Australian debt market, you can see, first of all, those spreads are around double their historic average. So good returns are on there, and of course the key risk, of course, is corporate defaults. But when we have a look at the average default rate in Australia, it's only 3%. And Australia's corporate bond market is actually highly concentrated at the high quality end. We don't have a particularly deep market in the C's and B's. Most of our securities actually are rated A. And when you have a look at your fixed interest portfolio, we also have to look at the government bond yield currently running at around 4.3%. Now, if history is any guide, interest rates will progressively rise as the economy strengthens in the next 12 months, if the RBA forecasts are right, and of course inflation is going to remain elevated. So there is a chance, of course, that bondholders would experience capital losses in the government debt market because simply interest rates at the moment and bond prices are just too expensive.